Good morning, everyone. We've had an election, and as is the case, we're not quite sure exactly how it has worked out yet, but we'll talk a little bit about that today, and also talk about where we may be going with regard to particularly tax legislation, but also some other areas over the coming months of this year, and then looking forward into next year. The agenda for today, as I said, let's just start with where we are this morning, and then get into some of the issues of where we could be going, and some of the influences that are going to affect where that may well be. I think now I have used Vic Harville's cartoon from actually a number of years ago for the start of every one of these presentations, and at least that has not changed. The State of the Union is still one of conflict, and is one where neither party is really able to establish entirely and establish entirely its view on things. The election itself, presidential election itself, the major media outlets have called the election for Joe Biden. There are a number of challenges that are being undertaken from the Republican side that could affect this outcome. In particular, Pennsylvania and Wisconsin, we know are going to be in recount, as well as Michigan and Arizona are likely to face that recount. Now, what this ultimately may mean, we really don't know. The indications are, and most of the calculations seem to favor the idea that there just are not enough votes to be changed in the recounts to effectively push the election away from Joe Biden back to President Trump. But that remains to be seen. It actually requires counting of votes. Certain votes that are being challenged in Pennsylvania are already being segregated. And so we will have to wait and see how that develops. Georgia also is, although not included in the 290 you see here, Georgia also is one that is probably heading for a recount. North Carolina, at this stage, does not necessarily look like it will be headed for a recount. The Republicans Trump has a significant lead in North Carolina. The Democratic candidate for senator, as we'll get to on the next slide, or in two slides, has already indicated that he has conceded. And so consequently, it's not clear that there will need to be a recount there. Okay, let's move on to the House of Representatives. I think that the polls were indicating that the Democrats were going to have a very good election with regard to the House. And as is the case with a lot of the projections from the polls, it didn't turn out that way. The Democrats do clearly continue to hold a majority. I believe a couple of the questionable seats, the light blue dots that you see there, are pretty firmly in the Democratic camp. And so we're going to be looking at a situation where the Democrats will continue to have a majority. And of course, in the House, majority rules, and there's not a whole lot that the minority can do about it. There are techniques that can be used, but essentially it is a majority vote controls institution. So leaving that in Democratic hands, we move on to the Senate, and there things are somewhat questionable. As I said, we can go ahead and move the North Carolina dot into the red column. I think most observers believe that the Alaska dot also will move into the Republican column. Alaska takes longer to count votes than anywhere else in the country. It does require a certain number of them to be flown into Anchorage in order to be counted. So that is technically still not closed, but most people would look at this and say the current uh, division really is 50 to 48. That is that is the count, and that leaves the two seats in Georgia. Georgia has special rules. In Georgia, you are required to have a majority of the votes cast in order to win the Senate seat. No one in either of the two seats, both the 6-year seat and the short-term seat, was able to reach the 50.0001% level. And so consequently, we're going to have runoff elections in Georgia, which could ultimately determine the result of and who controls the Senate. Now, the Democrats would need to win both of the seats in order to take the vote to 50-50. If that is the case, then whoever ultimately turns out to be the vice president can cast the deciding vote and can establish which party is the majority party uh, in the Senate. Uh, let's talk a little bit about calendar, and this mostly relates to the presidential situation. But actually, there are very fixed dates that are established for when things have to happen for by law as the election goes forward. December 8th is in some ways probably the most important of those dates, in that this is the date by which recounts and court contests are required by law to be completed. Some question, I think, with regard to how that might be enforced, particularly with regard to the courts. But at least as a stated matter of law, December 8th is the date that we should have some final determinations. Note December 11th, the temporary government funding expires. Coming back to the presidential situation, electors meet on December 14th, and they cast their ballots within the state. Those are then transferred to the Senate, and are received in the Senate by December 23rd. The new Congress convenes on January 3rd, and then only after the new Congress has convened are the electors' votes counted in a joint session of the House and the Senate. Even though the ballots are received by the Senate, the count is taken in a joint session. And then finally, January 20 is the inauguration day. Now, one important date has been left out of this, and that is January the 5th. And that is the date that Georgia will have their runoff election. And so, despite the fact that the new Congress has convened as of January 3rd, and by the way, the current vice president does continue to be a voting member or a tie-breaking member of the Congress as it convenes, at least until the inauguration day. So that can be taken into account as we move forward. All right, there's the calendar. What is Congress going to be up to? What do we have to look forward to as we go forward? We definitely are going to have a lame duck session. In fact, the lame duck session has already begun. The Senate confirmed a couple of circuit court judges yesterday. I do not believe is only in pro forma session today, but is scheduled to come back in and actually take votes on tomorrow. So the lame duck session has begun. Now, question, okay, it's begun. What are we going to do in lame duck? Well, the first order of business, remember back to the calendar, one of the magic dates was December 11th. That's when the continuing resolution that was passed back in September to keep the government funding expires. And unless something is done, then we have a government shutdown again. Now, various approaches that could be taken. Right now, if you read the releases from the leadership of both parties, you will see that they do intend to complete an omnibus reconciliation by December the 11th. This is the same statement that has been made pretty much every time we've taken a continuing resolution into lame duck. And yeah, every once in a while they actually succeed. Probably more likely, because keep in mind, the Congress has not completed over half of the spending bills that need to be rolled into the reconciliation of spending with the budget. And so what we'll more likely see is a continuing resolution that will do one of two things. One, it will kick the can down the road closer to the end of December, possibly even right up to the last day of December. We've seen them do that before. Or I think also, particularly if the political situation regarding the presidential race settles down a little bit, we may see a continuing resolution that just kicks the can somewhere out into late winter or early spring, providing some additional time to include that. And of course, the final possibility is they do not reach an agreement or the president does not sign the agreement, in which case we'll have a government shutdown with all of the issues that tends to raise. What other things are to be talked about? Certainly there will be discussion of additional COVID-19 relief legislation. I mean, we saw strong bipartisan support for doing something prior to the election, but no agreement as to what to do or how much to do. Now, not any reason to believe that the old patterns have changed, but we do have some new players. Most importantly, probably, it does appear that the administration is taking a step back and that Majority Leader McConnell will be taking over negotiations for the Republicans. This means that the Senate Republicans perhaps are going to have a somewhat stronger role in deciding where things are going to go than it was the case when the administration seemed to be taking the lead. If that is the case, and there was significant complaint about the size of the package and the amount of spending that was taking place, it may well be that we are not talking about as large a package as perhaps was even on the table prior to the election. On the other hand, things do change in the nature of what is going to be acceptable. We no longer have, with the possible exception of the Georgia runoff, the same political pressures of what do we do, how do we position ourselves, how do we take this to the voting public, which may make it easier to come to some sort of agreement. Now, here, where the runoff elections in Georgia could play an important role. If the Republicans feel relatively confident that they are going to win the the two runoff elections, establishing then a 52-48 majority in the Senate, which is a working majority, then it may well be that they are less likely to give in and reach a compromise with the Democrats simply because they now have they now have leverage going forward. On the other hand, the Democrats facing that kind of reality may be more likely to try and reach an agreement because of the limited ability to deal with things in the future Congress. On the other hand, if the Democrats feel that they can and will win the Georgia runoffs, there suddenly is very little reason for them to strike a deal that will be effective on December 31st if they feel that they will actually have control of the Senate beginning January 20th, and then can quickly pass legislation that is more to their liking because they have the 50-50 split and could then use the Democratic vice president to push them over. Again, All of that depends upon one party or the other, or maybe both parties, coming to a conclusion as to what's going to happen in Georgia. And as long as Georgia stays a uncertainty, then that leaves open the opportunity and the place for compromise. And it may well be that compromise, sometimes being the route of least resistance, is something that we'll see. If we do have a compromise, what are we looking to see included? Clearly, I think the items here that you see on the slide are the ones that have pretty much reached a bipartisan agreement so far. We would likely see an additional round of PPP loans, probably much more targeted than the original list of PPP loans. And likely to accompany that are a couple of provisions, one of which is some forgiveness rules that would liberalize the ability to claim forgiveness, uh, particularly for some of the smaller amounts. We already have a pretty much a clear forgiveness rule for very small amounts. This might kick it up more into the $10 million loan range. That certainly is a number that we've heard discussed. The other issue, of course, with regard to the PPP loans is what happens when you have your PP loan forgiven and then you take the forgiven loan money and spend it on something that would otherwise be deductible. Treasury has issued a statement, has issued its opinion that those amounts are not deductible, and actually has laid out a fairly sound legal reasoning for that position. Uh, both parties in Congress have responded, well, that's not what we intended. Uh, and if we do see legislation involving the PPP loans, I think there remains a very good chance that we will see included in that a rule that does allow for the deduction, or in some cases, the capitalization of amounts that are expended that relate to forgiven PPP loans. Obviously, no guarantees in that. I know that some people are going to not be applying for forgiveness until after the end of the year, so that they do not have, at least as of the end of the year, a forgiveness position. Uh, but that is certainly something worth keeping an eye on. The employee retention credit, there has been a general agreement that that requires a little bit of expansion, and we would expect to see that. As time has gone on, it has become clear that certain segments of the economy are more particularly affected by the COVID-19 situation than others. And there does seem to be, and particularly now we refer to some openings on the Republican side, some more willingness to consider targeted relief, including targeted relief for states and cities, which had been a point of resistance, particularly from the administration in earlier discussions. Now, as we said, McConnell seems to be, and the Senate seems to be taking over negotiations on the Republican side. And so this may then open the gates to some relief from the states and cities standpoint, although I would not expect it to be anywhere near the size of the amounts that the Democrats included in their $3 trillion bill that was passed earlier in the year, or that was passed the House earlier in the year and never came up for a vote in the Senate. Tort protection is an item that is very much up in the air. This has been a favorite of Majority Leader McConnell. Exactly how it would be written is a matter of contention, uh, but it may well be that inclusion of something in this line is a price of getting the legislation from McConnell's standpoint. And so consequently, we need to at least be aware that that could be coming down the pike. Now, if we do get COVID legislation, or if we do get some form of budget and spending legislation, what is the outlook for extenders. And we've got, as usual, a number of provisions that are expiring at the end of this year. I mean, well, first of all, a number of the COVID-19 provisions from the CARES Act, from some Families First Act, expire at the end of 2020. Whether those are extended or not is going to be part of the COVID-19 negotiation. Uh, Probably not part of the so-called extender package. But there are some other big items that are going to be included. The work opportunity tax credit, the new markets tax credit, a whole question of designation of empowerment zones for their incentives. Uh, a lot of the various so-called green incentives, whether that be alternative energy or energy conservation, the ability of students and sometimes parents to deduct qualified tuition expenses, the ability to deduct mortgage insurance, the same as if it were interest on a mortgage, the special accelerated depreciable lives. I'm not sure we're looking at any motorsports facilities being placed in service this year, but in any case, that is something there, and very, very important for anyone who is supporting the microbrew industry. The reduced excise taxes for microbrewers, as well as some micro distillers, does expire at the end of 2020, and I'm sure that if you have dropped into your local microbrewer, you have been requested to sign some form of petition that this be dealt with. Certainly, I have had the opportunity to do a number of those. Are we going to get extenders? It's hard to say, uh, but the the assumption seems to be on most parties' behalf, probably not. There has developed a habit in Congress of not extending things as they are about to expire, but waiting until they have expired and then retroactively extending them. This is somewhat become ingrained in congressional behavior. I don't believe there is any member of Congress who believes that his job was threatened by failing to take on the extenders in a more timely basis. Certainly, when I've had the opportunity to accompany AICPA delegations or some other delegations to urge the need to address these prior to their expiration, we have not been met. We have not received a warm reception. Let's just leave it at that. So, will we have extenders? We can all hope so. But habit seems to be against that. Habit seems to argue that that is likely not to be the case. One thing to keep in mind is the more contentious lame duck is, given the necessity of dealing with the spending bills and at least a continuing resolution to keep the government open, the easier it will be to pass that kind of legislation, the fewer added passengers are trying to come onto the legislation. And that in and of itself may be reason enough that the extenders uh, are kicked on. There is at this point no indication that the extenders are in deep trouble. Although as we move forward, it may be that sometime in 2021, there could be an examination of some of these, particularly in the green incentive area. We might see an expansion. Some of the others we might see tinkering with, and not just a straight extension. So those are items to keep in mind. I would not run away from any of them at this point. But it does, if you are looking and taking advantage of any of these, it does pay to keep your eye on how these are progressing. Let's move on now to the question of what we might be seeing coming in 2021. And I think the first thing that we have to do here is to take a look at what potentially President-elect Biden has included in his campaign platform. Now, I will focus here on two words: campaign proposals. There are lots of things in any candidate's election platform, campaign platform, that may or may not ultimately see the light of day, even if that candidate is ultimately successful in the election. This may be particularly true in the case of uh, Biden, in that there was a part of his election strategy was to make sure that his left flank did not abandon him. And so there are proposals here that may be more intended to reflect the concerns and provide that group of Democrats with a voice than they are necessarily to be pushed forward into ultimate enactment. However, they are on the table, and some of them do tie in with other things that President-elect Biden has indicated that he wants to do. And so I think it's worthwhile to take a look at the totality of these, uh, but keeping in mind that, again, these are campaign proposals. These are not things that have specifically been laid out. And I'll just go back with a little bit of a history note. If you look at some of the provisions that President Obama ran on, for instance, a number of those, particularly in the tax side, were never even really addressed. Particularly, I think of things that occurred in the regime of taxation, international activities of domestic businesses, but also some of the more radical thoughts, particularly with regard to state taxes and other sorts of wealth transfer proposals. They were always included in the campaign materials. They never really made it onto the floor of Congress. Uh, I guess one other note, we're going to focus today on Vice President Biden's proposals. If and when the situation with regard to the presidential vote changes as a result of recounts, as a result of the court challenges, we will clearly come back and in another session focus in on President Trump's campaign proposals. But for today, I think that it behooves us to, if for no other reason that there are more changes involved in Biden's proposals, behooves us to take a closer look at those. Let's start with the business proposals. One that I think has gotten a lot of attention is the idea of increasing the corporate rate from its current 21% to 28%. That is there is some discussion as to whether that 28% is a must or whether just an increase in the corporate rate is would be satisfactory. 25% was the rate that was originally proposed in the Republican package that became the TCJA. And there has been some discussion about whether 25% might be a good place for compromise. But at least at the moment, the proposal from the Biden camp is for 28%. Excuse me. In addition, there is a proposal, and this would only apply to corporations with earnings over $100 million. Earnings are not defined. Is that taxable income? Is that some other measure of income? But it does involve a $100 million amount. And it would be book-based, and it would be worldwide book-based. And it raises the specter of the very unsuccessful business untaxed reported profits provision that was in effect from 1987 to 1989. A few of your other gray hairs may remember what a delight that was, and all of the problems that were created by that. if this one goes forward, there's a lot of work to be done before it is really ready for prime time. Um, Increased taxes on the international activities. The Democrats under Obama had a number of ideas as to how they wanted to address international activities, including the shift that we ultimately saw from a credit system to more of a territorial system. The Republicans, when President Trump took control, took office, were able to take some of those ideas, give them their own spin, and implement them as part of TCJA. The Democrats would like to have their own crack at this. I'm not sure that they have clearly defined what it is they exactly want to do, other than probably increase uh, or at least make it more difficult to hide income overseas. But again, it's an area that is likely to be of focus, but one which is probably not ready for prime time. A final business tax proposal that should be noted, and this deals really, I think, for your higher income taxpayers, would be the restriction of the use of the pass-through deduction, the 199 cap A deduction for partnerships and or for the owners of partnerships and S corporations. The term that is being used is higher income taxpayers. It's not clear the exact amount this refers to, although the term higher income individual taxpayer has typically referred to taxable income over $400,000 in other parts of the Biden proposal. And I think we would need to go on the assumption that that is at least what is proposed. Now, over on the individual side, there is more detail. There are more proposals. And frankly, these might be ones that should the Democrats gain control of the Senate, have a greater chance of enactment. And again, $400,000 is going to be, as you see, kind of a magic number with regard to individual taxable income. But to take to essentially eliminate some of the TCJA benefits, take the top rate back up to 39.6%. There is a proposal to tax capital gains and dividends in excess of $1 million at ordinary income rates. Limit itemized deductions for taxable income for high taxable incomes. Missing some detail there as to whether that means we're going to get the percentage reduction back, whether this is just going to be a flat cutoff. And also changes in regard to the estate taxes, returning the estate tax rates to, quote, historical norms. We're not sure what that means. We think it is probably the pre-TCJA numbers. I guess arguably that could go back to something in the 40s and 50s where the rate was significantly higher, although that seems unlikely. There's also discussion in the proposals of eliminating step up in basis for large estates. Enormous compliance problems with that that we saw in the temporary period under President Bush, when that was an alternative to an estate tax, and not a lot of people took them up on that. And so I think that is one, as is the case with some of the corporate, if it is going to go forward, will require some additional work. Also, I would say that either of these two estate tax concepts are likely to face some significant opposition, not just from Republicans, but from some Democrats. And unless these are accompanied by a lot of phase in and a lot of exceptions and a lot of special rules that would apply to small businesses, would apply to agriculture, these would be very, very heavy lifts for any Democratic majority, much less the kind of narrow Democratic majority that is the only one that at least is possible right now. Would be very difficult for them to accomplish. Finally, and this one I think really is worth some noting, although it is also going to face a lot of difficulties for the Democrats to move forward, would be to apply the Social Security taxes. And it appears this is both the employer and employee side to earned income over $400,000. Now, if you take all of these and roll them together, then you would be looking at a tax rate of close to 50% on very large amounts of taxable income. And that in and of itself is something to note. And also, it is probably something to indicate how difficult it may be, and maybe undesirable it may be, to implement all of these separate ideas. The particularly, I think the idea of applying the Social Security tax rate above $400,000. Keep in mind, under existing Senate rules, it takes 60 votes in order to agree to take a vote where legislation can be passed by 51 votes. The way around that, and that has typically been used with regard to tax legislation, is what's called budget reconciliation. And so long as you are covered by budget reconciliation, current Senate rules allow you to avoid that 60 vote requirement on the front end to get legislation to the floor. Well, but you can't affect the Social Security funds and use budget reconciliation. So at least under the current rules, this last provision would have to be dropped from any tax legislation that needed to move forward in the Senate under budget reconciliation. Again, I think it's something to keep in mind. It's something to keep an eye on, but it's not necessarily something that is definitively going to happen, and certainly going to happen anytime soon. So, what is the message to all of this? I would say, at least from the Hitchhiker's Guide to the Biden proposals, don't panic. The totality of these changes are not coming down the pike immediately. Why don't panic? Well, let's look at something that maybe causes panic that is the reason not to panic so much about taxes. This is the Conference Board's economic outlook for the U.S. economy. And you can barely see a little dotted line there at the top. That was the glide path of domestic product growth had there been no coronavirus. The black line is the Conference Board's best estimate, at least as of a month ago, as to where things are going, given the effect on the economy of the coronavirus. And as you can see, it has not. We're still down. And in fact, the blue line, which was their downside forecast, some of the events that have occurred, some of the new calculations that we're seeing, some of the expanded infection rates and additional shutdowns that we're seeing are going to bring us closer to the blue line than to the black line, and certainly are going to make reaching that upside forecast extraordinarily difficult to reach. Given that we just need, taxes are not going to be job one in the case of a Biden administration. The immediate focus is going to be on COVID-19 issues. So taxes might be included in COVID-19, but the kind of drastic changes in the U.S. tax system that we saw listed on the two slides from the Biden proposals are not going to be coming down the pike within the first couple of months. Number one, it's not the focus. I think there also has been expressed, particularly by some of the economists on the Democratic side, who are likely to have a role in a Biden administration, that increasing taxes during an economic downturn is not a great idea. And then also, I just simply reflect the idea. Some of the stuff that was in some of the stuff that was in the campaign platform is just not ready for prime time, and that there's going to need to be some time to work through. And some of those proposals are going to be very easily attacked until they are buttoned up a little bit further. Also, keep in mind, although there were tax proposals in Biden's campaign, it was not really the primary feature. The primary feature of the Biden campaign was the COVID-19 situation, the idea that he would be a better manager of the COVID-19 situation, as taxes were a way to finance things that Biden and the Democrats wanted to do. It was not like the Republicans, who would say reducing taxes is an important good. On the Democrats were more of, yeah, we could increase taxes, but we increase taxes to pay for something else we want to do. So it does not have the same urgency in many ways as a policy item in a Democratic administration, that perhaps we saw the tax cuts be a need in a Republican administration. Finally, the Senate's going to be a gatekeeper. I mean, we looked at the numbers. The best the Democrats are going to be able to do is 50-50 with the vice president breaking the tie. That is not a recipe for being able to control the situation. And in fact, the contentiousness, for a lot of reasons, is going to be is going to prevent, I think, things that would resemble the sort of drastic changes that at least were included in Biden's campaign proposals from taking place early in his administration. Now, we mentioned the 50-50 split using the vice president to break ties. That assumes that the Democrats can win both of the runoffs in Georgia. If that is not the case, and certainly Democrats have not shown a great ability to turn out their voters for special elections. If the Republicans were to win at least one of the Georgia runoffs, then the split is 51-49, 52-48. Senator McConnell retains his position as the majority leader. And except for an extremely rarely used Rule 16 discharge petition, the majority leader determines what can be considered on the Senate floor. And while one would not expect him to use that to prevent any Democratic proposal from ever reaching the Senate floor, it might well be a power that he would use to keep Democratic tax increases away from consideration. And if that's the case, uh, I think it adds up entirely to the idea that there are some real restrictions on the ability, even if we have a Biden presidency, to implement some of these major changes and to implement them quickly. Uh, Always worth keeping an eye on. Always worth figuring out whether, particularly I think in the case of small to medium sized businesses, is there going to be an argument that some of these, particularly business proposals, should be intended for the biggest boys and not for us? Congress can be receptive to those sorts of arguments if they are carefully made. And we may well see that as a feature as we go forward as well. Uh, There's another reason, but I think that we do also need to be cognizant that just as the decline in the gross domestic product projections makes COVID-19 job one of a new Biden administration, uh, ultimately the money that is being spent, the federal money that is being spent on COVID-19, is going to limit what can be done in the future without really taking the deficit through the roof. And with that, let me see if we can't get this to, here we go. Uh, you can't lose sight of the fact that there is a national debt and that it is growing. And that if you look kind of tucked in here behind our photographs, is the projection. This is the Congressional Budget Office of where we are going in terms of federal debt held by the public as a percentage of annual gross domestic product. And we see that previously our high point was during World War II, and that took us slightly over 100%. Uh, Given current spending patterns, extrapolated out to 2049, we're getting close to 200%. And that is a lot of money. And keep in mind, this is debt held by this does not include debt that is being purchased by the Federal Reserve and tucked into the Federal Reserve's dresser drawer. How is this happening? Well, as is always the case, outlays are going faster than revenues. And as the farther we go out, the bigger that spread is positioned. Why? Because of the money that we're borrowing now to reflect the COVID situation. And all the economists will agree we need to get the economy through this COVID problem. But the net interest that is going to accrue with respect to that spending is going to become a significant portion of federal outlays as we move forward in time. Now, uh, this does assume higher interest rates than the 0% we're seeing right now, but it does not assume the very high interest rates that, for instance, we dealt with back in the 80s and 90s. We're talking about 30-year T-bills, T-bonds going in the 3 to 4% range, as opposed to the lower ranges that we see right now. What does that ultimately mean? Well, here's another little bit of a graphic. As you can see, the primary deficit does not include interest. That's what the difference between these two numbers are. The primary deficit being the light purple, the total deficit being the dark purple. And you can see again the relative increase in the contribution to the deficit that this represents. Now, it may be that we find a way to simply ignore this. This does not affect, this is many, many years in the future. Current members of Congress will long be retired by then. What me worry? But by the same token, it is a number that ultimately is going to crimp the ability of Congress to continue to spend money the way it has been spending money in the past year. If COVID-19 is brought under control, then perhaps that kind of spending no longer is necessary, and these issues go away. Although keep in mind, these numbers assume that most of the COVID-19 spending that was included in the CARES and the Families First Act does go away at the end of 2020, because this is based on a projection based on current law, and current law does not extend those provisions beyond that date, does not include an additional round of PPP, does not include an expanded employee retention credit. Also, I think we have dealt with a period of less concern about the size of the deficit and about deficit spending than would normally be the case from a Republican administration. Uh, if that if the next Republican administration is more traditional in its makeup and more concerned with the deficit issue, then it may well be that we see a tighter regime and we see less of a willingness to spend and perhaps a greater willingness to say that where we do have to have spending, we may need some additional revenues. Is that next year? Probably not. Is that 2022? Probably not. Is it somewhere in the future? It seems that that is likely to be the case. Although I guess we've been running larger and larger deficits for quite a while, and maybe we're just being scared off. I will conclude with that. And Amy, I'm sure we've had a few questions that have come in. What do we have to address with people? This is a good one. Will the Families First leave time options be extended into 2021? Yes, I think they likely will be if we get COVID-19 legislation, particularly if we get COVID-19 legislation in the lame duck session. If COVID-19 legislation waits until afterwards, I think there is a good chance that it could be retroactive, or at least the ability to recover payments that are made could be retroactively restored. I think it would be very difficult for the mandate to provide paid leave to be retroactively restored. So it may well be that what you would see if we deal with COVID-19 after lame duck, after 2021 has begun, is sort of a fresh start on Families First, and not something that specifically needs to be taken care of. PPP, amended return. Well, there is a broad issue with regard to what happens with respect to PPP funds when the loan is forgiven. Do we get to deduct those amounts? Under what circumstances might we get to deduct those amounts? What do you do? Well, many of us hope that Congress will solve this problem and will retroactively make them deductible, which solves a whole lot of problems, particularly if Congress can get around to doing that before any of us has to file a 2020 return. For those who are on fiscal years, or if Congress takes, as sometimes is the case, longer to do things than we would hope, I think it does raise, the way the current law is written and is being interpreted, it would seem that if you claim the deduction in 2020 and then receive the forgiveness in 2021, you will need to go back and amend the 2020 return. Does that mean that it would be, is there no opportunity to instead take an adjustment on the 2021 return? Under current guidance, I would say probably not, although that is the kind of guidance that faced with this, Congress might, or excuse me, the IRS and Treasury might ultimately entertain. This is not exactly a claim of right type adjustment, but that is one. I think that there are a whole range of questions that come into play depending upon whether you have satisfied forgiveness, have asked for forgiveness before or after the end of your taxable year 2020. And I think that that is one where you need to really consult with your specific tax advisor, and you may need to make your own conclusions as to how you want to handle that. I think that particularly it deals with the question of, do I ask for forgiveness now, or do I wait and ask for forgiveness in 2021? And of course, there's always the opportunity if we're still waiting for Congress to do something, extensions of the 2020 return may be in order for various reasons, not just this one. What percentage odds would you peg on Biden doing his estate tax changes in year one of his presidency, assuming he gets control of the Senate? I would say single digit at best. There is always a place for doing estate planning tomorrow. I would not say I think that a retroactive change back to January 1 is highly unlikely. First of all, moving this kind of change through through Congress would be extremely difficult. Uh, Maybe you could move an increase back to the TCJA rate, but the big items are the mark to market, the mark to market, those ideas. Those are going to be extremely difficult under any circumstances to be pushed through in 2021. That doesn't mean that having a state plan that can take changes of that type into account in your back pocket is a bad idea. And I would say that if you're in a position to develop some alternative plans that could be implemented if things do really pick up steam, would be something worthwhile. But I would, as a general rule, not undo things that have been put in place. Things that have been put in place have been thoughtfully put in place on the offhand chance that we really can see some of these things rammed through that quickly. We get into 2022, we get into 2023. Who knows what could happen? But a lot of the discussion is, particularly if the Senate holds in Republican hands, these sorts of major changes in 2021 and 22 are going to be incredibly difficult for the Democrats to achieve. And I would hate to see things done for a non-economic reason that turns out to have been a low percentage chance in any case. Let me scan down here, and I think we're gonna up. Yeah, well, I didn't know there's very important here. Julie Jeffrey contributes that some leading thinkers, including Mr. Blottmacher, are recommending staying on track with year-end gift planning. So that is, I certainly would not want to disagree with Mr. Blottmacher, who I think is a reliable source. Question here about the outlook for Senate races in 22. The Republicans will have a number of seats to defend in 22. Almost all of them either in states that voted for President Trump or are the conflicted states like Pennsylvania. So yes, the Republicans will have a lot of seats to defend, but what are the chances that they will have a significant loss in those seats? 2 years away is a long way, but it is something to be considered. And I think Amy is now ringing me in and saying I got to get off.
Yes.
Please, if I think is my email somewhere. If I didn't get to your question, if you have another question you'd like to ask, it's mschwartz, all one word, and there's no T in Schwartz, at eidbailey.com, and I'll be happy to respond to anything that you either didn't get a chance to ask or I didn't get a chance to answer. And thank you all for joining me today. Look forward to talking with you again sometime in December, perhaps when we have a little bit better sense of what the final count is going to be.